Well, hello and welcome back to uh, Principles of Microeconomics. I am your host, Dr. B, and today we're going to be talking about how to think like an economist. And what we mean by thinking like an economist, we think about how a scientist would think, break down components of theories, and we'll look at a couple of models. And that's what thinking like an economist really means is to think like a scientist or think like someone who looks at theories, breaks them down, and then we'll look at the individual models. And that's what we're going to talk about in the lecture now. So what I'd like to do is just to remind you where we are in the classroom as we get started is in the classroom, come down to module 1, and we are in week 2. So you'll open up week 2, and then you'll click on this one that says week 2. And you can find the PowerPoint presentations here to follow along. And to accompany this chapter, you'll have chapter 2 homework. So just as before, it's typically about 5 questions, mixed true, false, multiple choice. Relatively straightforward. You get 2 attempts, and the higher the 2 attempts will be taken in the grade book. So let's go ahead and take a look at thinking like an economist. And we'll talk about a couple of different concepts and models and things like that. So if you have any questions along the way, just feel free to unmute your microphone and ask your question, because I will be here along the way to help. So let's go ahead and take a look at what does thinking like an economist mean. There's a couple of different roles that economists have. One is more theoretical, or scientific, if you will. And the other one has to do with developing models. Remember, the economy, like we talked about last week, the economy is really more like an idea than it is a what do you call it's more like an idea than it is something that's tangible. Okay, that's what economics is. It's conceptual. Of a lot of theories you'll see. And these concepts and theories help individuals to understand how transactions impact them and impact their daily lives. And so, is this not, I'm sorry, behaving strangely. Hold on just 1 second. There we go. Close enough. Anyway, so thinking like an economist. Oh, sorry. This darn thing likes to scroll sometimes. We're going to take a look at a couple different models, and we're going to talk about this concept called the production possibilities frontier. And this has to do with opportunity cost. We talked about opportunity cost last week. And opportunity costs are the costs that are foregone. The costs that that's what opportunity cost means, is the costs that are foregone. When you make a decision in business, you look at 2 alternatives, alternative A and alternative B. And when we're looking at opportunity cost, it's the cost of the opportunity that you did not select. That's what the word opportunity cost means. And so we'll talk about how to illustrate opportunity cost when we talk about production of products. And we'll also talk briefly about the differences between micro and macroeconomics. So, economists. I like to think of economists as being science, but I also think of it as being a theory. Okay. But there's 2 roles that they play. One is scientific, and it's very data driven. And the other one is policy driven. Now, I want you to think about today's environment in this year, 2022, as all of you are probably aware by now, we are experiencing this thing called inflation. What inflation is the value of the dollar decreases because there are too many dollars available in the marketplace. When there's too much spending, whether it be government spending or coupled with individual spending, the when there's too much spending, that means there's too much money in circulation. There's a lot of government spending, there's a lot of individual spending, so that causes what we call inflation. There's too many dollars in the market. And to reduce inflation, we make it more difficult to borrow money. And the way to do that is to raise the interest rates. And those are policy decisions. Those types of decisions come from policy. The science part of it is production and the amount of physical dollars on the market. That's the science part. The policy part is we can control interest rates to control something like inflation. We talked a little bit about that last week. So it's science and it's policy. Those are the two roles that economists typically play. In the science part, this is where theory comes into play, okay? And modeling. There's a couple of curves we'll talk about, like the Laffer curve. We'll talk about things like supply and demand curves. And that's really the scientific part of things. And we can test the outer limits of those types of curves. And so that's where the science part comes into play. So in science, there's a couple of assumptions that we need to make in order for us to be able to develop theories and models. And the assumptions are that we would need to make things simple to understand, especially when we're dealing with a complex subject like economics. An example of that would be, in order for us to understand how international trade works, we can assume that there are two different countries and only a few goods that they are exchanging. That's international trade, right? So, for example, in the United States, we import a lot of our cars from Mexico. A lot of them are made in Mexico. They have American names like Chevy, Ford, GM, whatever. If you look at the door jamb on the car, it'll say where it's made, right, or where it's assembled. And oftentimes it's in Mexico. And there's a couple of reasons for that. Usually the labor is more affordable in Mexico. And so the trade is America imports the car and we export money, right, for the product. So that's an example of international trade. And that's something that's very common here in the United States. I could go on and on. There's so many different examples. We get a lot of avocados from Mexico and Peru. We get a lot of fruits and vegetables from other countries. That's very normal. And the exchange is we receive the goods, right, the produce, and we send currency, funds. So that's an example. Those are examples of international trade. And so when there's problems, or before there's problems, economists will develop models to understand these issues, right? And so the models are like graphs, they're graphs and charts. And there's some math, of course, but there's graphs and charts, and they represent the complexity. And so these are ways for economists, scientists, understand economics in a general sense. You know, model. There's so many different examples of models. I'm not a big fan of these ones, but a map that can be a model. Um, let's see. For those of you with children, maybe your child might have a Matchbox car. You know, the little Matchbox cars. They used to be made of metal. I'm sure most of them are plastic now, but those are models. They're model cars. Uh, you know, there's so many different examples of models. But in economics, our models typically involve like graphs and charts. So here's an example of a chart, or I guess a diagram would be, it's called a circular flow chart, or circular flow diagram. And it's a visual model of the economy. It shows us things like how dollars flow through different markets and how they flow through households. And I'm going to show you this exchange. The way I want you to think about this is think about how to track a dollar. Okay, each dollar has a serial number on it, and we can track the dollar. We can find out where your dollar went. So if you go to, let's say you go to the corner store today and you buy a pack of gum for $1, you can track where that dollar goes after you spent it. Okay, it's really cool because you can see where the dollar ends up. And uh, the reason why I bring that up is when you went to the corner store, there was an exchange. You gave the store owner $1 and you received a pack of gum. Okay, so that's an economic transaction. And in that transaction, $1 outflow from the house, $1 inflow to the business, right? That part of that dollar was originally spent on the inventory that got to the corner store from a vendor, and before that, it was being manufactured somewhere. And when the pack of gum was manufactured, there were dollars spent on labor and materials. And so, just thinking about that concept of how things flow naturally in the environment, that is how the general economics works. So there's really two parties involved in the circular diagram. That's firms and households. Firms meaning businesses, and households meaning households, you know, where people live. And there's interactions. You know, we purchase goods. That should say goods, not gods. Market for goods and services, and market for factors of production, which means to produce a product. So this is what the circular flow looks like. So the companies, the firms, they uh, purchase their products or their services to sell to the households. Oh, I apologize. I don't know why I did that. It's kind of weird. So this is the flow. This is how the diagram flows. So here's how I want you to think about this. The company employs you. You live in a house. The company employs you. Okay? So that the company is spending money on you in the form of wages. The company also pays things like rent and other items to the market factors, but the company pays you in the form of wages, which is your income, right? So that if we follow the green line out from firms, wages goes to the household as a form of income. The household, which is you, you spend money on goods and services. You know, daily life stuff. Going to the grocery store, you're spending money. You know, so let's say you work at a grocery store. The grocery store pays you a wage. Your paycheck. Your paycheck is your income, and you spend your paycheck on groceries. So the spending goes back into the company, the grocery store, as a form of revenue. And it goes round and round, just like that. And we can also see that the company, the grocery store, buys their produce or their items from their suppliers. We call that factors of production. The company sells the goods and services, the grocery store sells their products on the market, and they're bought by the households. And the households also spend on things like labor, land, and capital that go into the markets that then go into the company. So we see how the cycle works. This is why we call it circular flow. It goes in both directions. So the firms earn money through revenue, and they also spend money on goods and services. The households earn income from working at the company, and the households also spend money at the company. So we see that it's cyclical, right? That's why we call it a circular flow. The next thing I want to talk to you about is called the production possibilities frontier. And this is a model. Okay. And this model shows us the outputs that the economy can possibly produce. There's a lot of different outputs. And the outputs are based on things like the factors of production, which are labor and materials and overhead, and technology. As you know, technology aims to improve the output of products. The better we got robots, they can develop the products along with the humans, etc., and make it more efficient. That's the kind of technology we're talking about. And so we'll go over this concept with an example. And so I want you to think about these two products. I want you to think about a computer, and I want you to think about wheat. Wheat is the stuff that you would find in like your cereal and your bread and wheat. It's found in a lot of different products. So computers and wheat. Computers, of course, is technology, and wheat is used in production. And I also want you to think about a resource, and the resource is labor. Labor, as you know, the people that work in the company. And this is measured in terms of hours. So number of hours worked, that's labor. The whole economy has 50,000 labor hours per month available for producing products at the company. So in thinking of this example, it takes 100 hours to manufacture one computer. And it takes 10 hours to manufacture 1 ton of wheat. And graphically, it's going to make me do this every time, right? We can look at the factors of production. So remember, I have 50,000 labor hours available per month. If I use all of my hours solely focusing on making computers, I can make 50,000 computers. I'm sorry, I use 50,000 hours making the computers, I can make 500 computers. And 0 wheat because I didn't use any of my hours on wheat. If I used 40,000 hours making computers and 10,000 hours making wheat, I can produce 400 computers and 1,000 tons of wheat. If I spend 25,000 hours on computers and 25,000 hours on wheat, that means I can produce 250 computers and 2,500 tons of wheat. We see where we're going with this, right? Remember, there's only two products at this company, computers and wheat. Okay? And there's only 50,000 labor hours available every month. In business, sometimes we have to make decisions on where to spend our labor hours. If I only have two products, I have to decide how many hours each month I'm going to use making those products. And so the formula is relatively simple. We take the number of hours dedicated to each product and we divide that by the number of hours it takes to produce one product. If it takes 100 hours to make one computer, 40,000 divided by 100 is 400. If it takes 10 hours to produce 1 ton of wheat, 10,000 divided by 10 is 1,000. So forth and so on. You all see how this works, right? Y'all doing okay? Not too sleepy, are you? Miss Rose, oh, I'm sorry, Miss, what's your new last name, Miss Rhodes? For some reason, I can't hear you. Can you all hear me?
Yes,
Yes,
I can hear you.
Yes, we can hear you.
Okay, thank you.
yes.
Okay, thank you so much. It's so strange. But for some reason, I couldn't hear Miss Rhodes talking there, so I apologize. We're not quite too sure what happened. Miss Anthony, thank you. I was trying so hard to remember your new last name. Uh, cool. Great, great. Okay, but you all understand this concept, right? Uh, so we take the number of labor hours dedicated to producing that product, and we divide that by the number of hours required to produce one unit. And that's what gives us the number of production. Cool. Awesome. Thank you. Okay. So we can graph this out. And graphically, we can identify each point of production, A, B, C, D, and E. And we can see it's downward sloping and to the right. And what that tells us is, and this goes back to the concept we talked about earlier called opportunity cost. Remember, the company only has 50,000 labor hours per month, and I'm only producing two products. The opportunity cost is what's foregone. So if I produce 500 computers, that means I cannot produce any wheat, all right? Because again, I'm constrained to the number of hours. If I have 50,000 labor hours and it takes me 100 hours to make one computer, that means I can only do 500 computers and I can't do any wheat because I used all that time to do the computers. That's the opportunity cost, is what was foregone on the wheat, which would have been 5,000 tons. And so we see the correlation, and it's downward sloping into the right. And each of these points represents the points in the graph. On the graph, we saw the correlation. 100 computers, 3,000 tons of wheat. That was at label F, or would have been label F. The question is it possible for the economy to produce this type of combination of the two goods? Why or why not? So in other words, can I produce 100 computers and 3,000 tons of wheat? Can I produce 3,000 tons of wheat and 100 computers? 3,000 tons of wheat and 100 computers? Maybe. 3,000 tons of wheat and 100 computers. I would say, yeah, we probably could. And then it says next, find a point that represents 300 computers and 3,500 tons of wheat. Can we produce them? So it said 300 computers, 3,500 tons of wheat. Can we produce it? That answer is probably not. Okay, so if we look at the graph, right, 3,500 tons which be between 3,000 and 400. And it said 300 computers, that's outside the bounds. So the answer for that would be no, we can't do that. So F, yeah, we could do it. It wouldn't be efficient, right? Because the line represents maximum efficiency. We could do it, but it wouldn't be efficient. And point G would be outside the bounds. So that would not be possible, especially for limited 50,000 hours per month. So when we're looking at production possibility frontiers, it's important to understand efficiency. The word efficiency simply means we're maximizing our units of production. We're maximizing our units of production. If I'm given 50,000 hours a month, the way to maximize that time is to identify the level of units that I can produce efficiently by using all of my production abilities, all my resources. That's what it means to be efficient. So along that line that you saw in the graph, that's maximum efficiency. Over that graph, if you go outside the graph, it's not possible because there wouldn't be, you wouldn't have the possibility to produce it if it's over the line, if it's over maximum efficiency. You can't go over maximum efficiency. You can go under maximum efficiency, but your resources, like employees, will be underutilized, which ultimately leads to unemployment. And so that's what production possibilities frontier tells us. I can move along the line of maximum efficiency, but remember, there's the opportunity cost. I can produce all computers and no wheat, or I can produce all wheat and no computers. The opportunity cost is what's foregone. So ideally, you want to be somewhere along the middle of that production possibility frontier line to maximize output. So there's trade-offs. There's always going to be that sacrifice, and that's what the opportunity cost represents. It's a societal trade-off. So again, looking at the example, we can identify the formula for graphing this production possibility frontier. We call this rise over run. The rise over the run gives us the slope of the curve. You may have remembered this type of thing. I'm not sure if all of you took finite math yet, or a math course that involves some trigonometry. But something like this would show up. So to find the slope, we take the rise of the slope over the run of the slope. Rise over the run. And we do that based off the increments, right? On the y-axis, to find the rise, 4,000 to 5,000, the difference is 1,000. So the rise is 1,000. In this case, it's minus 1,000 because you have to go down. Yeah. The run represents the difference on the x-axis, 0 to 100. So the run is 100 based off the increment, right? The number, yeah. So 100, which is the run, represents the difference in the increment on the x-axis. So 0 to 100 is the run, which means 100. The rise represents the difference in increments on the y-axis. Y means up and down. In this example, 1,000. So we say minus 1,000 because it goes down. Remember, the line trajectory is down, yes? So minus 1,000 because it goes down. And the run goes up 100. 0 to 100 is up. 5,000 to 4,000 is down 1,000. That's why the minus sign. So we can calculate the opportunity cost. The opportunity cost is producing one computer is equivalent to producing 10 tons of wheat. So one computer is equivalent to 10 tons of wheat. That is the opportunity cost. So if I produce one computer, that means I sacrifice being able to produce 10 tons of wheat. And that's how we think about opportunity cost. It's the cost foregone. Okay, so here's a good question. Which country is the opportunity cost of cloth lower? Opportunity cost of cloth lower. What do we think?
England,
England? Uh, yeah, I would think so. Why do you think England?
because of the I say the influx of it. Like, yeah, I say the influx of it. It's like it's not too high, but it's not too low either. So it's
Yeah,
not like a dramatic change.
you got it. You said it. It's dramatic change, right? So if you look at the slope of the line, it's not as dramatic as it is in France, as we see.
Yeah.
Yeah, it's not as sharp a drop. Yeah, you're right. So yeah, I would think England as well because we can see the opportunity cost is probably what 100 it looks like, and um, hmm,
Or they can be the
yeah,
same.
I think you're right. But let's see. Let's see what the answer. So England, yes, because you said it. It's not as steep. So if you think of the line, the sharper the line, the more um, drastic the difference is. So very good job. You got it right, Naheem. You nailed it. Yeah, exactly right. Yes, please. Did you have a question or?
Oh no, I was trying to put the hands up, the thumbs up.
No worries. No worries. Awesome. Thank you. Okay. when we use technology, we can uh, enhance our production level. We can get more output, okay, when we use technology. And so when we use technology in production, if we get more output, this means it will cause a shift in the production. I can never say this right. The production possibility. Uh, Jeff again. The line of output we see will shift when we introduce um, ways to enhance our frontier. That's the word. Ways to enhance our production output. You can see the line shift when we enhance the production output using technology. So, in thinking about the graph, the line, a straight line would represent a constant opportunity cost. If it's constant, that means it doesn't change with the level of output. It'll be the same. Okay. Uh, and if it's bowed outward, that's funny. If it's kind of like a curvature, but downward and to the right, you'll see more units of goods that are being produced. You need to give up more in opportunity cost. So down and to the right, there's a greater opportunity cost. It's steeper. When the slope of the line is steeper, that means there's more opportunity cost given. But not at first. So remember, when we're introducing technology, the idea is to enhance the level of output. And with that enhanced level of output, at first, the slope isn't so bad. But we see it getting sharper later on. Because we're producing more later on, that means that later on, there is more opportunity cost involved, which is why it has this bow shape, yeah, bow shape, curvature in the line. So we see at point A, opportunity cost is very low. Point A, very low, because toward the beginning, there's not as much involved because we're not producing as much. But as we produce more, the opportunity cost becomes very high because greater cost as we produce more. So why does this happen? Why is this bow, the line become curved? What happens is, and there can be multiple reasons, different skill sets with employees, different costs come into play. Well, the way I want you to think about it is when you're producing a product, the more that you produce, the expectation is there will be more costs associated with producing the additional level of output. So the more you're producing, of course, there's going to be more opportunity cost or more cost involved. And so that's why we see this sharper drop toward the end of the curve. One of the last concepts I want to talk about especially for this chapter, is the differences between microeconomics and macroeconomics. And some of you might be taking both right now, I think. And others of you might be taking just micro with me, and maybe you'll take macroeconomics, or we're taking macroeconomics now, or might be taking microeconomics later, or whatever. There's two different classes, Econ 1, 201, and Econ 202. They represent microeconomics and macroeconomics. So here's the difference. Microeconomics studies the households and the companies when they make decisions on a micro level. Micro level. So in microeconomics, I'm only looking at the household and the company. Okay, that's it. I'm not looking at the whole country. I'm just looking at transactions on a micro level, on a small level, which are households and businesses. Macroeconomics, I'm looking at it from the whole country. Okay? The whole country. I'm looking at the United States, and I'm looking at things like inflation, unemployment, economic growth, and how will these things impact the country? So when you think of the two terms, micro means small scale. Micro means small scale. Macro means wide scale, broad. Macro. Micro means finite. Macro means broad. Yeah, that's a way to think about the difference between the two types of economics. So, in macroeconomics, which is mostly this course, we'll be talking about concepts that happen to the whole country, not just small areas or not just individual companies and households. You'll hear me refer to the companies and households just for example purposes for the most part. So we talked about the science part. Now we'll talk a little bit about the policy. So in the United States, our central bank, which is the Federal Reserve, makes policy decisions that affect the economy in the United States. An example of this is to combat the current situation. As you know, right now we're experiencing inflation. Inflation is caused by too much government spending and too much individual spending. Those two things together, especially, will cause larger amounts of inflation. Simply means that there's too much money in circulation. That's what inflation is. And what happens when we have inflation, typically, normally, is that prices go up on everything. It's normal. There's a lot of money in circulation. The price has to go up in order to absorb all that money in circulation. And also, I will say, is that prices go up and there's usually a consequence. The prices go up on everything, things become a little unaffordable. And so the government steps in and say, okay, we got to fix this. And the way to prevent from too much money in circulation is to make it more expensive to take out more money. And the way to do that is to raise interest rates. We raise the interest rates on borrowing, people will borrow less, and there will be less money in circulation. Think of it like you're at the stove in your house, you're cooking dinner, okay? And you got the knobs. You turn the knobs a little bit to control things like inflation. And that's what the government's doing right now. Uh, those are policy decisions. And this is one of many policy decisions that the Federal Reserve makes. There are other examples, of course. At times of, there are examples like, well, should the government adjust the minimum wage? The whole creation of minimum wages is relatively newer concept. Minimum wage has only been around since I believe it's the 1940s. So it's not that long ago. But the government constantly looks at policy decisions in order to have an influence on the economy. And those types of decisions could be what we call positive or normative, nominal. So here's a couple of examples. When prices rise, the government increases the quantity of money. No, that's normative. That's not true. Um, when the when there's too much money in circulation, that's what causes the prices to rise. Right? So that correlation is a positive correlation. The government should print less money. That's a really a normative statement. I mean, we want them to print less money because that's what will ultimately reduce inflation. During times of difficulty, the government will sometimes cut taxes in order to stimulate the economy. That's true. Uh, in order for new business creation to happen, oftentimes the government will provide tax incentives for those new businesses to happen in the economy, create new jobs and things like that. So they'll cut taxes. That's what happens during economic downturns. When there's if there's this one's funny. If there's an increase in the price of burritos, it will cause an increase in consumer demand for music downloads. It's an inverse relationship, yeah. Uh, that's probably a normative. Just funny, yeah. But the point here is to show you the correlation when there's changes in the situation. Okay. Oh, sorry. You'll also notice, like, if you ever watch the news or whatever, and they talk about inflation, people disagree all the time. What caused it? How can we fix it? It's very normal for economists to disagree, uh, because they look at different models and they look at different ways of looking at policy. Um, so yeah, that's just that's just the way it works. Okay. Uh, where are we? Oh yeah, proposition. Um, most economists will agree on certain things, like having rent control will reduce the quantity and quality of housing available. It's true. It's very true. Because it will cause less demand for development. Tariffs and import quotas will reduce general economic welfare. To a degree, yeah, that's mostly true. That's why you see 93% agree. The United States should not restrict employees from outsourcing work to foreign countries. Most agree. The reason for that is to reduce the cost of labor for the companies. The United States should eliminate our agricultural subsidies. 85% economists agree with that. I'm indifferent personally on that one. Local and state governments should eliminate subsidies for professional sport franchises. And 85% agree. Yeah, I mean, those teams are rich enough. They can pay for their own stadium. They don't need, they don't, the District of Columbia does not need to be financing the new Commanders um, place to play. Yeah, I mean, why? The team's got enough money. They can build their own. We don't need the taxpayers to pay for that. It's just me. I can go on and on like this, but there's some examples of how they agree and disagree. And these are the summaries. Uh, I'll let you take care of that part. Okay, so that's chapter two. Any questions on chapter two? Thinking like an economist. Pretty straightforward, yeah. I'm sorry, Miss Anthony. For some reason, I see you unmute, but I can't hear anything. I don't know what it is. It might be your microphone connection, maybe, or microphone volume. I don't know. Yeah, they play in Maryland. Yeah, I don't know. Uh, we'll see. We'll see for how long. uh, it's okay, Miss Anthony. You know, I'm sure you'll get it fixed. Okay, so that's chapter two. You also have the accompanying chapter two homework. Let's jump into chapter three. We'll spend the next 20 minutes talking about chapter three. So let me stop this part of the recording, and I'll start a new one for the next chapter.